Hey everybody, it's Craig Moser. It's November the 9th, 2021. This year's flown by, I know. Wanted to go over a few things with you in the market and just have a brief chat. And so I will just try to get started here. Hang on just a second. Let me get to my charting system, which I always seem to fall back on. Okay, so in no particular order, I happen to have gold, the Gold Trust ETF, GLD up here, and you can see making lower highs. So we're not really not going to cover off the ball with gold for this year. If you look at 2 years, gold spiked in August of last year, and since then has had a fairly slow decline, but yet still a decline. So gold's not really helping in the portfolios so far. All right, let's look for a minute at the bond market, the bond aggregate. I'm looking over 2 years, so you can see we had this thing happen back last March, February and March, and then the bond market stabilized. That's primarily due to the fact that the Federal Reserve Bank backstopped most of these bonds. So, as they start to do what's called a taper, meaning they quit having purchases, but it's not a dead stop, they taper off, you will see what the real bond market looks like. Now, the other dynamic to the bond market is, of course, interest rates, which are extremely low. So you have an inverse relationship between bonds and stocks. What happens when rates go up, since these bonds and this bond aggregate have already been issued, and whatever their interest payments are already a fixed rate, if you will, then what's going to happen is if they raise rates, you will see the price of this bond or this index ETF begin to decline due to the fact that the interest rates have increased, but yet you have a set payment in the bonds. Now, a way to maybe offset that would be to use something like a TIPS bond. So what is that? It's basically the same bond I just showed you. This is a 0 to 5 year TIPS, but you can do a regular TIP. And what they do is they add to, with some frequency, they add to that the CPI rate. So it helps this type of bond to track with, obviously, inflation gives you a little more yield. So a 362 yield is not that bad given what the world is like. So short term, the bonds are not doing that great. So it seems like the yield curve is kind of getting a little flat. Long term, though, if you look at, say, a long-term treasury as an example, we're starting to see a little move up, a little bit of a move up over here on the right. Let me just use a 1 year chart. It'll look a little different. You can see long-term bonds plateaued last year and have actually started to move in a little bit more of an upper trend. So not sure exactly what this is telling us, but you can see the short term and the long term are giving us some messages. I don't know how mixed they are. Let's look at the S&P 500 as an example, SPX. So SPX over the last year has been a run, been incredible. It's been making new highs. Why is that? So my view is that there's a lot of new capital in the system trying to find a home, and people are going back to work. If you look at the earnings numbers that are coming in from most of these companies, and maybe focus on revenues for a minute, you'll see that most of these companies are starting to make quite a bit of money. So a lot of money, people going back to work. It's a nice recipe for economic growth in the U.S. Now, there's some headwinds. Mind you, there's some headwinds. There's some things in front of us. We have a lot of debt. We have an issue with labor, I'll put it that way. We have some supply chain issues. And then, of course, if we see a substantial increase in taxes that impact the growth engines in the country, then that will also be something that we're going to have to learn to deal with. We've done it before. Maybe it's a little more prevalent to you now because the messages are pretty loud, depending on which side you listen to. And so just understand that it's not all rosy here, but things are certainly improving from 2021. Let's look at our friends in the developed world without the United States. So this is Europe, Australia, mostly Japan, the Far East, those types of things. And you can see that we're sort of in a flat base here, if you will. I do these from time to time. Sorry, this is on the fly, but you can see that really from about right here, we've had sort of a range, and this is back here is I don't know, maybe April of last year. So trying to find some space on the upside, but hasn't really broken out to the upside like the S&P 500 has. Just to give you a comparison, the S&P has broken out from its base and is starting to move up. So that's a good thing. Same thing with NASDAQ. I typically bring NASDAQ into the picture because it's not the same list of companies. So NASDAQ, had its flattening right in here, which was obviously during the COVID hit, right in this range. And then NASDAQ, because it is tech laden, has really done really good over the past 1 year, and really pretty darn good over 2 years. If you look at it and say, wow, rocking and rolling. You can see 2021 sort of flat, 2020, obviously most stock driven, equity driven type indexes have had an issue last March, but most of it is moving up and been pretty substantial and looks pretty good at this point. We'll do a few different, so we can do small cap. So small cap, we're using iShares ETF so I can give you a visual. We're breaking off of a base here, and that looks like, at least for the interim, this particular index is starting to move north, looking pretty good. We'll see how long that sustains itself, but all good right now, and don't fight the trend. Same thing with mid caps. If you look at mid caps, a similar sort of story is prevalent here. We based, and it looks like the breakout is going to be to the upside. So that's always good if you're the owner of stocks. If you're shorting these things, not so hot, but we'll see how it goes. So stock markets around the world look decent. Emerging markets, probably the one that's struggling the most because of some of the issues that we're seeing primarily in China, government driven, not so much economic driven as it is government driven, but just things change. And so just be aware that right now, when you look at companies in emerging markets, Russia, India, China, those types of areas, sort of flattened out and about where they were back in, say, December of last year, trying to find a tailwind to move up, but so far not. Don't want to bore you to tears with this. Just be aware that in the United States, obviously, if you compare the U.S., I'll do the S&P and do a comparison here. You'll see what I mean. Here's the S&P over 2 years. We compare Europe, Australia, and the Far East to that. There's the comparison to that. So we're tracking ahead of Europe. And if you compare to emerging markets, we're tracking ahead of them as well. So what is. Pay attention to these accounts. The markets are extremely high. And that doesn't mean they're not going to go higher. There's a lot of capital in the markets, a lot of money being printed. That's a 5-year look at these same charts. So you can see everybody was great until the end of January 2018. And then the U.S. has moved substantially beyond the rest of the world, at least for the two indexes that I'm showing you here. So we're the biggest economy. We're supposed to move ahead. Have we made the right moves? Only history is going to tell us. But wanted to share some time with you. If you have questions, as always, give us a call, 336-448-1086. Happy to help you at any time, and hope you have a lovely Thanksgiving and time with your family. Stay healthy, and we'll talk to you next month.